Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. Learn about fix and flip loans, BRRRR financing, rental, fix to rent, commercial, multifamily bridge loans, business loans, and so much more. And now, your host, Beau Eckstein.
Hi, and welcome to another episode of the Investor Financing Podcast. And today I'm going to do it a little different. I'm going to do an intro to our guest today. And really enjoyed the interview with Rohan Jahar of JT Capital. Rohan is super sharp, okay? You're talking about a young millennial, well, not that young, but 30-year-old gentleman. He has experience working in venture capital with GE. He also worked for strategy and finance for Facebook. And then he got into the multifamily syndication world and multifamily investing. Just loved the conversation. You guys are going to enjoy it. Super sharp guy. He's closing on a huge, I think it's 300 units in Austin right now. Over $30 million acquisition. Okay, he's been involved in over $500 million in transactions. Him and his partners. Super sharp. You're gonna love all the nuggets you're gonna get out of this call or this Zoom, and really appreciate you guys out there that are following this podcast, whether it's on YouTube or it's on Libsyn or iTunes or wherever you are. Really appreciate you. Going to continue to bring great guests on, and we also talk about lending, which is my specialty. But I like to get inside the minds of these investors and find out where they're buying, how they're structuring the deals, all the good stuff that I'm sure you want to hear too. All right, well, that's enough. I will start the interview.
You're listening to the Investor Financing Podcast. We'll be right back after this break. Are you looking for funding? Are you getting frustrated trying to find a lender? Visit investorfinancingpodcast.com and click the Get Funding button. Complete the simple form and schedule a free phone consultation with one of our placement specialists. We have a proprietary directory of funding partners that can help you get the funding you need. It's fast and easy to explore the options available for your specific needs. Don't wait. Visit investorfinancingpodcast.com and get connected.
All right, so we are here now with Rohan Jahar, and I said it correctly, right? Jahar?
Exactly. You got it right.
Yes, I would have said it right anyways, but I like how you broke it down for me because it made it easier. I always second guess myself when I'm pronouncing people's names. I don't know why, but anyways. Great to have you. And prior to us going live here, I found out that you're related to a good friend of mine. So it is a small world we live in, right? And everybody's connected in one way or the other. But let's kind of dive back prior to real estate. And what I like about what I've already found out prior to us jumping here live is that you're representing the millennials. And you've got a lot of experience in tech and financial services and a great background. And then you got into multifamily. So I kind of want to basically after you graduated school, getting into your career, and then what made you kind of shift your mind into getting into multifamily, and kind of walk us through that a little bit.
Yeah, for sure. So I had started kind of my career GE. I was originally born and raised in Michigan. And so going to a company like GE was a little bit groundbreaking because I was from this really small town. And so, going to GE, you had this opportunity to kind of travel the world, see all these different businesses and everything like that. So it's really interesting for me. I spent some time there. I had the opportunity to kind of, rise throughout my career fairly quickly, which was great. And then at some point I moved over to Silicon Valley. My cousin was out there. He had mentioned just all of the fascinating and exciting things going on, especially as it related to people building their companies. And I had this entrepreneurial spirit. that I would say was dampened down for going to work at a corporation. So kind of in the least risk averse way possible, or most risk averse way rather, I moved out to San Francisco and went to go work at Facebook. And while I was at Facebook, it was really interesting. I tell people that going from a company like GE to Facebook, when I went to Facebook, it felt like it was this Disney World for grown-ups. There was just, free ice cream, free massages, free lunches. It was crazy. But after a little bit of time there, then you kind of get into the work, and it was fun for some period of time, but I still had this itch to kind of, go on my entrepreneurial journey. And so after some time at Facebook, kind of working on finance, operations, strategy, and then real estate in particular, I kind of scratched the itch of real estate, and it became really exciting to me. And so what I did is started looking at, what are other real estate asset classes out there that are good to invest in. And during that time, I was investing in different asset classes, looking at different investment opportunities. And what I saw was an opportunity to get into multifamily, which was a very resilient asset class and still is today, but do it from the perspective of not being passive and actually being active. And so, went through what I would call kind of a mini apprenticeship to really learn the ins and outs of multifamily, and then kind of had confidence to say, I think I can go do this for myself, and kind of build my portfolio that way. And so that's when I kind of made the transition, started the company, formed JT Capital, and started pursuing these acquisitions in multifamily that we've been doing. And it's been great. It's a really good investment class. I think investors love kind of the investor appetite for this asset class, especially when you can get tax advantaged cash flows, and, continue to build equity for the future.
That's awesome. So you kind of bypassed the whole single family, fixing up houses kind of thing. You kind of just went in with your financial background, and you have a pretty analytical mind, I can tell already. So you live in spreadsheets, and that was pretty easy for you to adapt. And really, the difference in multifamily is it's just all pure numbers, really, right? So a lot of my real estate contacts, they first cut their teeth in the single family market, right? And then they go, okay, well, there's no scaling this. And then they get into multifamily. You kind of is that kind of your first real estate asset that you kind of dove into?
Pretty much. It's funny. I was actually going to go into single family first. So I said, I believe colleges will be resilient for at least the next 5 to 10 years, and still have a lot of students. And so I said, why don't I go purchase just single family houses in these college towns? Because you have college kids who will always be there. So you have demand to a certain extent. You have limited supply based on where you're buying. And then you always have kind of the parents that are co-signers on these. So you have a very kind of good mix to be able to generate cash flow. But what I very quickly realized was that it would take a very long time to kind of scale up, because unless you're buying a portfolio, which is somewhat tough, you're going to need to buy each individual house, and closing on an individual house takes just as much time as closing on a large scale apartment complex or office building or industrial warehouse or anything like that. And so I said, why don't people just go big from the very beginning? And what I realized, it was kind of this psychological thing where people feel like they need to start small and then scale up. But what I realized is if you just partner with the right people, you bring the right value that you're adding, you can go after those big deals. And so I had enough confidence, kind of knowing what I had done both at Facebook and at GE, that I could add value in those big deals. And so I pretty much just hit the ground running to say, I'm going to start underwriting every large deal that I can find. I am going to do the project management as it relates to the entire kind of due diligence and asset takeover. And I'm just going to say yes to pretty much every single thing that is asked of me. And so that's how I had approached it, to say, I can just go find the people that I admire that are doing this, rather than trying to do it all myself and start off at a very small scale.
That's really smart. You kind of just, you basically sped up your investing business, from a 10-year learning period to a 2-year learning period, just by doing that. And and that you're so right about the mindset thing. A lot of us, we just think, well, I can't afford this $30 million building, right? And I need to do this $50,000 house in Indiana because it's more comfortable. And they're in their comfort zone, right? And they don't realize that how many of those houses do you actually have to buy and hold to actually get the cash flow from one building? And I started, flipping houses, and then I bought, cheap houses, and I kind of bird them and refinanced them, but that's a lot of work. And then I met Vinny 4 or 5 years ago, and seeing how he just went big, and his mindset on looking at deals, it's like it opened up my mind to really, when it comes down to it, it's really about partnering with the right people and finding people that have different skill sets that complement your business. So going a little bit further in that, you're kind of you're finding sourcing the deals and underwriting the deals. Is that kind of like what you do with the team? Like what do you do with the team, and then what do your partners do? Are you raising capital, or is it mostly them?
Yeah, exactly. So we kind of covered a bunch of different aspects, right? So from my perspective, I will source deals, I will underwrite deals, I'll work with our investors to raise capital as well as answer their questions. And then as we take over the deal, I'm involved from a strategic standpoint and kind of high level review standpoint, and then sometimes getting deep into the details and rolling up my sleeves and getting dirty where it's needed. My other partners focus more on kind of portfolio management, disposition strategy, and then kind of like the marketing and back office functions. So as it relates to the sourcing, it's just getting those deals, either one from brokers, which are on market, off market, but then also connecting with owners directly to see, what is out there that people maybe are looking to trade soon, or that they weren't even looking to trade it, but based on the right price, the right terms, or if you can convince them, it may be a good opportunity. And then the underwriting, is just kind of well within my wheelhouse based on my previous experience. And then from an investor relations perspective, it's tapping into my network as well as developing new connections to be able to find who are the right people that, one, know about this asset class and want to invest with good operators, or two, people that don't even really know about multifamily real estate, but they want to get that exposure to, the great tax advantages that you get from real estate while not needing to work so hard, but rather be on the passive side because, they have other businesses to run. And that's kind of how I, generally speaking, spend my time. I spend a lot of time also just setting aside time to think and read. That's reading everything from not only real estate stuff, but other industries, other aspects of areas that I believe might not necessarily be complementary to real estate, but you can learn things and then apply them to real estate. And then it even relates to everything from, back from my tech world. I like to stay close to that as well.
So you also, I was reading on your bio that you work for a billionaire in the crypto world, and just what's your take on crypto? When is this going to happen? When is digital currency going to take over the dollar? Is that coming in the next 5 years, in your opinion?
I don't think it's going to happen within the next 5 years. I think a lot will need to happen for it to actually be replaced. I love the ethos behind crypto. I very fully believe in decentralization. I very fully believe in kind of a decentralized internet. I very fully believe that kind of this crowdsource model of ideas, of funding, of fractional ownership is great for everybody. But the kind of Bitcoin or any other type of cryptocurrency that could ultimately replace a fiat-backed currency, I think is going to take a really long time. And, there have to be very terrible things that occur, like wars, for that to actually occur. Now, having said that, we've seen the Fed print an unprecedented amount of money, which has kind of, kept the stock market levels where it's at, kept financial asset values where they're at. But it's really decreasing the purchasing power of a dollar. And so saving money right now is not incentivized because you're in fact losing money by saving money. And so it will be very interesting to see kind of what happens. I really believe in the ethos of crypto, but I think in terms of replacing, fiat-backed currencies, it may take some time.
And kind of touching on what's going on with the world right now, with COVID, And the world is really kind of changing every day it's changing now. I mean, you see these commercial kitchens, these ghost kitchens, like you see these large retail companies shutting down. You see so much transformation. I mean, what do you think about it, like right now? And like, what do you think is going to, what do you foresee happening with like these small businesses in general? And what do you think is going to happen? Do you see more entrepreneurship, do you see a new emergence of people buying businesses that are, I think right now I'm seeing a lot of people thinking that there's going to be opportunities to buy distressed businesses. I'm just kind of thinking, to get inside your head, you're making a very large acquisition right now in Austin, which is a great market. So you definitely have confidence in that market, and you have confidence in like the job growth there and stuff. So how do you see a huge, you're seeing a lot of people relocate. You're seeing shifts in the way people work. How do you think this is going to play out over the next couple of years?
Yeah, I think first at a broad level, I think COVID has taught us, one, that we never know what's going to happen in the future. And there's always like extremely uncertain times and uncertainty on any given day. We never know really what's even going to happen tomorrow. And so I kind of, really hesitate to provide, what I believe exactly will happen within a certain time frame, but rather what I believe could happen over a longer time frame. One, but then two, at least give some type of probability into what I believe. And so I think kind of what we're seeing in the short term right now is the government has stepped in to do kind of what they can. One, to be able to support individuals and small businesses. But then two, I think more broadly, and quite frankly, just to stop a revolution. If they hadn't implemented the programs that they did to kind of, print that unprecedented amount of money that we talked about, give these helicopter payments to individuals, not only would businesses have failed, but then everybody's 401k accounts, investing accounts also would have dropped drastically. And so not only at that point would people not be getting income, but then their net worth would decrease, a substantial amount. So I think they pretty much took all the right steps that they could have done during that time. If there's one thing I would have kind of criticized or said could have been changed, it would have actually been more payments to individuals and for a longer period of time, vis-a-vis this universal basic income that we're effectively implementing versus, printing so much money and buying all these different kinds of assets. Now, as it relates to kind of, the next few years and the outlook there, I think that from a, brick and mortar perspective, small businesses that have not had the chance to kind of fully open or operate at a much smaller level, like 25% capacity, will ultimately end up failing if the virus kind of continues to pervade our society and doesn't allow people to kind of have the mobility that we've had previously. And so there's going to be, a substantial amount of these businesses that will fail, I believe. Now, having said that, there are trillions of dollars of dry powder sitting on the sidelines that people are going to put to work. So one, they will either invest behind the small businesses that are struggling. Two, they will either go buy these portfolios of businesses. Or three, they will let the dust kind of settle and then new businesses will just be built. So I don't see this as kind of some, reckoning that's about to occur where small businesses are dead in America, but rather, there will be some pain that is felt, some restructuring on the debt side. But ultimately, if you believe in America, kind of the entrepreneurship and innovation, things will be kind of rebuilt back up. Now, I think from a entrepreneurship perspective and what you had talked about is, more people building businesses, we've seen this kind of accelerated growth in e-commerce. E-commerce as a percentage of total retail over the past decade has grown from, I think roughly 2% to 16%. And now just this year alone, it's doubled from 16% to over 30%. And so it's very easy for an individual or an entrepreneur anywhere in the world to open up a digital storefront on Shopify or on WooCommerce and effectively start selling goods over the internet. And so I think you're going to continue to see that because it's becoming easier for people to start these businesses with lower capital and lower barriers to entry. But at the same time, that also means increased competition from anybody in the world, as long as you have a laptop and an internet connection.
So when you recently found this new property in Austin, um, what's your kind of criteria when you're buying? You're looking for A minus, B plus type assets built in 1985 or 1990 and newer, typically. With how many are you looking for? 150 units and greater. What's kind of like your mindset, like where to buy and what to buy?
Yeah, absolutely. So, the first thing we kind of look at is what is the market that we're going into? Do we like this particular market? The reason we went into Austin and Dallas is because we're very bullish on these two cities within Texas. I think Texas has shown just this, willingness to invest behind businesses, behind landlords, and make it very easy to do business in the state. The no state income tax, the warm climate has had people that have just been flocking here for a decade. And now, again, with COVID being the catalyst for kind of this shift to potential remote work being pervasive in our community, you see now all of the people in tech now moving here in flocks. Myself being an example, moving from San Francisco to Austin, Texas, and having a lot of friends who have made the same type of move. So that's one thing we look at is kind of the market. Second, what we look at then is, kind of drilling down into it. Okay, do we like this neighborhood? Right? Is this on a path of progress? Do we like the area that's around here? Are things being built up? Then the next thing we look at is, okay, the asset, right? What is this property? How is it performed? Who's living at the property? Are there different things we can change on the property? Do we like the structural condition of it? All of those kinds of things. And then ultimately, do the numbers actually work on this property? So we have two verticals that we look at. One is, kind of our value add play, where we will buy these properties that are anywhere from 150 units to 500 units. And that purchase price usually lands somewhere in the range of, let's say, $20 million to $70 million. And then the second vertical that we have is kind of our buy and hold vertical. So this is where we're looking at assets that maybe are $4 million up to $20 million. And that might be anywhere from as small as 20 units, maybe up to like 130, 140 units. And those ones we're just buying and holding forever. First strategy, it allows our investors to be able to, one, invest passively, get that tax advantage cash flow in the form of preferred rate of return that we distribute either monthly or quarterly. And then as we sell that property in 5 years after increasing rents, increasing income, it allows the investors to obviously partake in a big equity gain from the sale of that property. For the second one, it's what I would call for, more conservative or just longer term holding investors, where really what they're looking for is, we just want to buy a property and we want it to cash flow forever. And we want to give it to our kids maybe, or we just want to, exit it after 50 years, but we're buying it in a market that we truly, truly believe in for the long term. So those are kind of, our checklist of criteria, as well as the way that we kind of think about our verticals of the business.
And both of those verticals are both syndication models. Even the long-term holds are typically, you're syndicating those as well.
Yeah, I think on the first one, kind of the bigger deals, that one is syndication. On the other deals, kind of like the buy and hold, I would call it more partnerships. So we structure that usually with just one or two other investors, because we try to keep that one a little bit closer group. One, based on the fact we don't usually need as much capital to be able to purchase those deals. And then two, when you have those kind of small deals, you just don't want so many people in it, because you want to make sure that you're kind of maintaining the right control group for the property.
So your idea on like the value add smaller properties that you're keeping long term, is it to go in, stabilize the property, raise rents, renovate, and then year 3 to 5 refinance and pay? You usually try to pay back the investor at that point, their principal, and then everything else is gravy. Is that kind of how your model looks on that model?
Yeah, on the buy and hold, it usually depends, right? Where we're at with interest rates, they're very attractive right now. Yeah. So typically in both we don't usually model in a refi, but we leave open the option to be able to do it, because then obviously we're able to make contributions back to the investors, and people are able to effectively rake in millions of dollars, in year 1 or 2, year 2 or 3 rather. For the buy and hold, though, specifically, what we will do is we will find some of these kind of what we believe to be potentially undervalued properties. We do renovations, so we try to get rents where we believe they can be, but we're very, very conservative in that. But then two, I think what we really focus on is building out that community, because we want to have people that really love living there for a long time. Because on those smaller assets, if you have high turnover, it can add a lot of thrash and a lot of cost and a lot of overhead for you to be able to operate those properties. So in those properties, one, because they're smaller, and two, because of just the economics, we really like to just focus more on building out that community, so people stay there for the long term. Whereas on the bigger ones, although we'll build out community, just based on the fact you have so many people, you get, a relatively high turnover. Let's say on the minimal side, it might be 10%. On the higher side, it might be up to 40%. But usually that's congruent with your strategy of raising rents and getting new people in there. On the smaller ones, if 20 people to 40 people are living in an apartment complex, you're hoping that all of them are friends. Because if they're all friends, if you've built out good community programs, then people want to live by their friends and stay there for a long time.
On those long-term holds, would you say you're doing kind of light renovations? You're not looking for like a C- property where you're going in and doing a complete gut job? Are those more like the occupancy levels at, almost 90%? I mean, they're not huge. Are you willing to take on the really kind of heavy lift projects too? Or are you just looking for something that's a little bit faster?
Generally speaking, we're looking for the light value add, right? So maybe we just need to go in there, upgrade the countertops, put appliances, maybe change the cabinetry, things like that. But now as we're kind of continuing to build out that vertical, we are becoming more comfortable with doing some of the heavy value add. So if we need to start knocking out walls, creating more open space, we're kind of okay with that. One, just based on, our expertise as well as the investors that we have in that property. But then two, we know that we're building it out for the long term. So we're willing to kind of roll up our sleeves and do a lot more heavy value add work in the very beginning, because we know that we can extract a lot of value by maybe moving that property up from a C to kind of a B+ or an A-, particularly if it's in a really good neighborhood, especially, down here in Austin, where you have some of these older properties that are sitting in kind of these prime real estate locations.
What about other asset classes? If you weren't so heavily involved in multifamily right now, what asset classes, doesn't necessarily have to be real estate, or what are you doing now? What do you invest your money in besides multifamily?
Yeah, so from a real estate perspective, it is industrial, it is self-storage, and I'm interested in mobile home parks, but I haven't went that route yet. Outside of real estate, I think that from a private placement perspective, I really love just boring businesses that are just essential to the economy. What I mean by a boring business is it could be like a landscaping company, it could be an automotive supplier, it could be a granite distributor. These are companies which, in my old world of Silicon Valley, we didn't really ever talk about or even think about, because we were focused on these kind of new concept product ideas that we can grow very quickly at 7% week over week. But there's a whole different world out there of just these essential businesses that drive real value, that have owner operated earnings of maybe as little as $5 million up to $100 million a year. And there's a lot of these businesses that are out there. And one of my kind of thesis is right now is that there's a lot of these businesses that have older individuals that have been running them for a really long time, that have just been doing core blocking and tackling and building amazing businesses. But as they kind of get to this retirement age and looking to shut down those businesses, there's a great opportunity for millennials to be able to partner with those operators, extract all of the knowledge that they have, and start running those businesses, not only from a brick and mortar perspective, but also being able to use things like online marketing, direct to consumer, to continue to extract value from those businesses. So a little bit of a tangent there, but those are the other kinds of businesses that I like. And then outside of that, it's just the pure play tech stuff, things like crypto, and then just early stage tech that I always like to look at.
I think you're dead on about the businesses. And I went down one of those rabbit holes. I started looking at franchises and things. It's a whole world I never really looked at. But, I do think that with the millennials being able to kind of use their technology, right? Like their skill sets at these older businesses that are, essential businesses that they never really developed like an outreach program to develop business online, right? But they're yet a very profitable company. But it's amazing what we have for technology. I mean, we're on Zoom right now, right? Like this is the biggest tool since everybody on. I mean, what's the use that's gone up on Zoom over COVID? I couldn't even imagine how I've used Zoom like every day now, where before I'd use it maybe once a week. Now I'm using it every day. So it's just these technologies are going to come more and more and more. So it's quite amazing. Yeah, that's so.
Yeah, there's a funny graph actually where I think right when COVID hit, Zoom shows their daily active users or monthly actives. I'm not entirely sure, but it went from something like 10 million to 300 million in the course of like 3 weeks, I think. So it's pretty amazing how, you can build out these software companies and get kind of zero incremental cost to be able to acquire users.
And like your investors that are investing with you side by side on some of your syndications, are you finding what's the avatar? Is it usually somebody in their mid 30s to 50 that's investing with you, or is it the older demographic you're finding more success with right now? How are you going about finding the right investors for your projects that believe in you and believe in your properties?
Yeah, so kind of two bases of investors, I would say. One is kind of the older crowd, right? Anywhere from the ranges of like mid 40s up to 70s. And these are people that are, business owners or CEOs of companies who kind of have built out a strong amount of cash flow just on their specific expertise, but have also invested in other things and want to invest in multifamily. So that's kind of one base of investor I would say we would have. And then the second is just kind of the younger crowd. And this is people that are, I would say in their 30s from tech, again, maybe have done startups that they've exited successfully, or they are, software engineers at Facebook or a partner at Google Ventures, now known as Capital G. So just these kinds of people that, I've become friends with living in San Francisco, or two, I have just found, quite frankly, either through cold emailing or just being put in touch with because they had read something that I had written online. As well as, you kind of just get in this game and you start talking real estate all the time, and people kind of just make a lot of connections through word of mouth. Happy investors tell their friends, who then tell their friends, and then you begin to build up your investor base. But those are kind of the two groups of people we look at.
Cool. That was very good. Now, I liked how you said earlier how you carve out part of your day just to think, because many of us never do that, right? We get stuck, and we were talking about it earlier today and this is something I'm going to start practicing. It's called, what intermittent fasting is, where you only eat for maybe 6 hours out of the day, and then you fast the additional time. Well, we call it internet fasting. So you turn off all your distractions, right? No, you can go on your computer, but you essentially turn off the internet, so nobody can get a hold of you. And then you can do deep work, right? So you can actually think, and you can actually, because I think that people get caught up in the distractions of life, and they can't use their best tool, which is between their ears, right? They're too. So I'm definitely implementing that. Learning to turn off the phone, learning to turn off, my notifications, and then just working for a time period of 2 hours where you can accomplish a full days of work. And so I think all of us kind of millennials, I'll say I'm a millennial still, which I'm probably not, but that's the one thing, is that we're so addicted to technology that we need to kind of pull ourselves back a little bit to be more proactive.
Yeah, absolutely. I think you're right. And I love that idea. The one thing that has worked really well for me is putting my phone on Do Not Disturb. And so if anyone ever like needs to reach me, they kind of just can't until I actually look at my phone and I'm ready to kind of take on that task. And I figured, I don't have that many emergency calls. And if something truly is an emergency, it'll get to me. So Do Not Disturb is a superpower on the iPhone.
Yeah, that's good. That's really good. So as we kind of wrap up, this has been really good. I really enjoy picking your brain. Can you go into maybe some books that you really enjoy, or some podcasts? And it doesn't have to be specific to real estate, just like business and mindset, and maybe some tools you use that you might want to share with our audience.
Yeah, for sure. Happy to. So, I read a lot of books. I think the one that was probably the most influential to me was Poor Charlie's Almanac. Pretty much what it is it's just a collection of talks by Charlie Munger that was written by, one of his colleagues. Phenomenal book. It kind of opened the door and the pathway to just learning about everything that is worthwhile to learn if you want to be, I think, successful, not just really in investing, but in life. So Poor Charlie's Almanac is, one of my favorite books, and I reread it every year. Podcasts, I kind of just pick and choose based on, who the guest is or who they're talking about. A handful of the ones that I'll kind of listen to, depending on who's the guest, is, the Tim Ferriss podcast, Knowledge Project. Shane Parrish is really good. Let's see. Let me just actually pull up my Spotify, because I do listen to a lot of podcasts. So I want to make sure I'm able to give some good recommendations. The Anthony Pompliano podcast is really good. He's a crypto guy, but he'll have a bunch of other people on there. Invest Like Best with Patrick O'Shaughnessy is great. It's all about just kind of investing. A16Z podcast, if you want to learn about tech. And then lastly, there's one called My First Million. And that one is one of my favorites. It's just all about business ideas. And I think if you're someone who's in high school or college, or, just graduated college, or even in your 50s or 60s, and you just want to start a business, it's great. Just two guys that just talk about business ideas. So I really like that one. And then from a tools perspective, I think the things that have helped me are Evernote. So I pretty much take a lot of notes on any conversation I have, any discussion I have, any idea that pops into my head, because I know I'm never going to remember it. So I just write things down. Things 3 is like my to-do list. It's really good, a great way to be organized. And then lastly, for email, I use Superhuman. And Superhuman just has, this ability to kind of batch emails, structure things, organize them well, keyboard shortcuts. And then I only need to check email 3 times a day. So those are a few of the, kind of things I use that really help me stay structured.
Thank you. I'm going to check out Superhuman. That sounds pretty good to me.
Yeah, let me know. I'll send you a referral. I think there's a huge wait list, so I can get you at the top of the line.
Wow. So it's that good. So before we go, I guess, you're a pretty young guy and had a lot of success so far. 10 years from now, what are your goals? Where do you want to be? What's kind of your dream? The time you're 40, let's say, what would you like to do?
It's really tough. One thing I've realized is I don't even know really what's going to happen 1 year or 2 years from now. So the way that I think about it is, in 10 years from now, I hope me and my wife have a few kids. We're happy, we're healthy, we're safe. Our kids are doing well. And so that's really all that I know I kind of want. I hope that we are, doing well financially and all of that kind of stuff. But really for me, it's just all about freedom, happiness, healthiness, those kinds of things. From a business perspective, I just, me and my partners, both Pooja and Suppan, we just want to continue to grow the business as long as it continues to remain fun. At the first point that it starts kind of being a hassle or a chore or something that we don't really want to do, at that point we know that we kind of have done something wrong. And so for us, all we kind of optimize for is, the happiness, the freedom, and being healthy.
Awesome. Well, thank you so much. And thank all the viewers for watching this. And we'll see you on the next show.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.